You may or may not realize that you're able to insure not only your life, but also the life of others with some stipulations. And that's exactly what we're going to talk about today. How do you buy a policy on someone else's life? Hi, I'm Olivia Kirk.
I'm Tim Urich. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
Now, in most cases, when you purchase a life insurance policy, you will be both the owner and insured, meaning your life is the one that's going to be insured, as in the death benefit is going to be paid out when you die, and you're the owner, meaning you control the cash flow, you pay the premiums, you're able to change the beneficiary of the policy. All of those things are associated with being the owner. But sometimes, maybe you're not insurable, or maybe you'll suffer a financial loss when someone else dies, and so you want to purchase a policy on their life so that you could be the beneficiary, or you could be the owner of the policy and access those benefits associated with being the owner, like the cash value, for example.
Or the ability to change the dividend or control the dividend. But think of it this way. You want to purchase a life insurance policy, but maybe you're uninsurable. That's why the insurance industry has allowed people to purchase a policy on anyone with whom they have an insurable interest. And what's an insurable interest? Well, basically, it means that you will suffer some financial loss if that person passes away.
Yeah, so let's talk about who would qualify in that bucket. The people that you have insurable interest on. Maybe it's your spouse. Maybe it's your child. Maybe it's someone you're a co-signer on a loan and you'll have to pay the loan back if and when they die. Maybe it's your parent. Maybe you're dependent on your parent. Maybe it's your business partner. What are some other options?
A key person in your company, or somebody that you own some real estate with. Here's another one. We've insured people who were partners on an airplane. They both owned an airplane and they both had a loan to purchase the airplane. And so if something happened to one of the partners, the other partner wanted to make sure that the dying partner's share was taken care of. So they purchased insurance on each other.
Yeah, exactly. I mean, even if you have a roommate living with you sharing those expenses, in that case, you would suffer a financial loss. But what does this all boil down to? Basically, if you're trying to purchase a life insurance policy on someone else's life, we would have to, as the agent, explain to the insurance company what the financial loss would be if that person dies, right? What loss would you incur? And from there, it's just like regular underwriting. It would be, the majority of the underwriting would be on the insured's life because they're assessing the risk on their life, right? Mm-hmm. So they would have to fill out the application. They would have to get an insurance physical if necessary. They would have to get their medical records released to the insurance company if necessary. And they would have to sign the delivery requirements at the time of delivery. But other than that, it's mostly, it's all gravy after that. It's all in the hands of the policy owner after that. So, the owner will be on the insurance application. The owner will sign those delivery requirements, and then the owner will be in control of that policy.
And here's a key point. The insurable interest only has to exist at the time of application. So think of it. If Olivia and I own a business together and I apply for insurance on her and she applies for insurance on me, and we keep these policies, and 5 years later we sell our business, we could still keep the policies on each other because the insurable interest only has to exist at the time of application. Post-application, all bets are off. That's a huge contrast from purchasing insurance on a property.
That's exactly what I was thinking, right? When you have a homeowner's insurance policy.
The insurable interest has to exist throughout the contract. So that's a big distinction and a huge difference.
So what that means is, At the time of application, at the time of delivery, the insured signs over and says, okay, it's okay if they have a policy on me. And then you, as the owner, own and control that policy throughout their entire life. And ultimately, when they die, the death benefit's going to be paid out to you or to a beneficiary designated by you.
Yeah, so this solves the problem of what if you're uninsurable and you want to purchase a policy for infinite banking purposes. Well, no great shakes. All you got to do is find somebody with whom you have an insurable interest, purchase a policy on them, and then the key is you want to control the cash value, which, if you're the owner of the policy, you will control the cash value.
Now, if you are the insured, there are some things that you should consider before letting someone purchase a policy on you, right? Because you are signing off on this. The application process isn't that hard, right? So filling out the application with personal information, getting an insurance physical, having your medical records released to the insurance company. Those are all simple things. But you do have to keep in mind that this owner is going to have the policy throughout your life. You don't have any power to take that away from the policy owner. Additionally, after that policy is placed in force, you won't have access to any information that is regarding that policy. If you call up the insurance company, they're not going to be able to tell you anything because you're not the owner of the policy.
So if you're uninsurable, and you want to implement the infinite banking concept, it's real simple. Find somebody that you have an insurable interest in and buy a policy on them. Then you'll control the cash value, and then you can borrow against the cash value and do all the great things that infinite banking allows you to do.
You know, it's funny when people are talking about buying policies on someone else, they often think about buying it on the youngest person possible. But if you're already kind of old, you may want to think about buying it on someone older, especially if you have the budget for it, because when that person dies, you're going to come into a lump sum of money, right? So you'll have control of the cash value along the way, and then you'll also have some guaranteed windfall down the line as well. If you'd like to learn more about this process and how to implement it in your life, visit our website at tier1capital.com to schedule your free strategy session today. We'd be happy to talk to you about your specific situation and how you could get the most of it. Also, if you like this video, be sure to check out these two. We picked them out special for you. Don't forget to hit the thumbs up button and that subscribe.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.